You are sitting at your kitchen table on a Sunday morning. The coffee is hot, the house is quiet, your phone is face down beside a stack of unopened mail. You built this life carefully. You worked for 30 years, paid your mortgage, saved what you could, and when your son called you last spring to tell you he found a place, you did what any parent would do. You helped, you signed some paperwork. A lawyer explained something about a trust arrangement, something about putting your name on title to help him qualify for the mortgage. It sounded reasonable. It sounded like what parents do. You did not think of it as a financial instrument. You thought of it as love. This morning, one of those envelopes on the table is from the Canada Revenue Agency. It is not a newsletter. It is not a general notice. It is addressed specifically to you. And the number printed on the second page, the amount the CRA is now telling you that you owe on an asset you do not live in, do not control, and never intended to profit from, is going to make your coffee go cold before you finish reading it. Welcome back to Canada Property Watch. In our previous investigations, we exposed how the CRA's algorithmic data network is now cross-referencing every property transaction in Canada against income records, renovation permits, and rental platform data to execute retroactive tax reassessments against homeowners who thought they were completely clean. We also exposed how the deemed disposition rule is being used to seize family estates before beneficiaries even finish the probate process. Today, we are going inside a trap that is different from everything we have covered before. Because this one was not designed to catch criminals. It was not built to punish fraud. It was quietly restructured by the federal government to capture something far more ordinary, far more widespread, and far more devastating. It was redesigned to capture you. The arrangement is called a bare trust, and if you have ever helped your child buy a home, ever put your name on a property title to assist with mortgage qualification, ever held real estate on behalf of a family member for any reason whatsoever, the Canada Revenue Agency has a mathematical and legal position that says you may owe tax on gains you never collected, on a property you never truly owned, under rules that were not clearly communicated to the millions of Canadian families who were already inside these arrangements before the government changed its position. To understand exactly how this execution unfolds, you need to understand what a bare trust actually is, because the term sounds technical and harmless, and that is precisely why so many Canadians walked into it without understanding what they were signing. A bare trust is a legal arrangement in which one person, called the trustee, holds legal title to an asset on behalf of another person, called the beneficiary. The trustee has no independent power over that asset. They cannot sell it, mortgage it, or make decisions about it without the beneficiary's direction. In theory, the trustee is a name on paper. In practice, for thousands of Canadian families, that name on paper is a parent who helped their child get a mortgage when the bank said the child's income alone was not sufficient. This arrangement became extraordinarily common during the housing boom years between 2015 and 2022. A first-time buyer in Toronto, in Vancouver, in Calgary, in Ottawa, would approach a lender and discover that their debt-to-income ratio was too high, their down payment was too thin, or their employment history was too short to qualify a loan. A parent would step in. The parent's name would appear on title alongside the child. A lawyer would structure the arrangement as a bare trust, with a side agreement confirming that the parent had no beneficial interest in the property, that they were holding title purely to satisfy the lender's requirements. Families did this by the hundreds of thousands. Lawyers facilitated it. Mortgage brokers recommended it. It was considered standard practice. It was considered safe. What those families did not know, and what many of the professionals advising them did not adequately explain, was that putting a name on a property title, even as a bare trustee with zero beneficial ownership, creates a legal paper trail that the Canada Revenue Agency is now treating as a taxable event at the moment that name is removed from title. And that is where the machinery of destruction begins its work. Here is the precise legal and financial mechanism. When a parent is added to a property title, the CRA's position is that a disposition has occurred. The parent has acquired a legal interest in a property. The value of that interest at the moment of acquisition is recorded. Time passes, the market moves. In the cities where most of these arrangements were created, the market did not move gently, it detonated. A condominium that was worth $480,000 in 2018 was worth $720,000 by 2022. A semi-detached home in Mississauga that was purchased for $650,000 in 2019 was assessed at over $1 million by 2021. That appreciation did not belong to the parent. The parent was a name on paper. But when that name is removed from title, when the bare trust is unwound and the child takes full legal ownership, the CRA's algorithmic systems now flag that removal as a second disposition, a deemed sale. And the capital gain that the CRA calculates between the date the name was added and the date the name was removed becomes the taxable event. The parent never saw that money. The parent never collected a single dollar of that appreciation. The property was not theirs in any meaningful sense. But the Canada Revenue Agency's position under the restructured Bare Trust reporting framework is mathematically uncompromising. Legal title was held. Legal title was transferred. The gain is real. The tax is owed. Now, here is where the 2026 rule becomes the detonator. For years, Bare Trust existed in a reporting gray zone. The CRA had the theoretical power to assess these arrangements, but the practical reality was that most bare trusts were invisible to the agency's systems. There was no mandatory reporting requirement that forced Canadians to declare these arrangements annually. The government introduced T3 trust return filing requirements that were supposed to bring bare trusts into the light, starting with the 2023 tax year. The initial rollout was chaotic. The CRA reversed its position at the last moment and exempted most bare trusts from the 2023 filing deadline, creating widespread confusion about whether these arrangements needed to be reported at all. That exemption is gone. The government has clarified its position for the 2024 tax year and the filings due in 2025, with the full enforcement architecture operational for 2026. Bare trusts that were invisible are now visible. The data matching systems that connect land registry records, title transfer histories, and property assessment databases to individual tax files are now running at full capacity. Every name that appeared on a property title and then disappeared is a data point in those systems. Every arrangement that was structured, documented, and then unwound is a potential audit trigger. The CRA is not waiting for Canadians to come forward voluntarily. It is already running the comparisons. It is already generating the discrepancy flags. The letters are already being prepared. The cruelty of this trap, the element that distinguishes it from every other CRA enforcement story we have investigated on this channel, is that the families being targeted are not fraudsters. They are not people who built shadow rental empires or declared phantom principal residences on 5 properties simultaneously. They are parents who signed paperwork their children needed to start their adult lives. They are grandparents whose names appeared on a land transfer because a bank required it. They are people who did exactly what their lawyers told them to do, paid for professional advice, and are now receiving notices of reassessment for tax obligations they never imagined they had incurred. If you have been watching this channel since we first exposed the principal residence denial trap, you know that the CRA's enforcement approach does not require intent. It does not require knowledge. It requires only a transaction that fits a pattern the agency's systems have been instructed to identify and pursue. The bare trust situation fits that pattern with mathematical precision. Title was held. Title was transferred. The gain exists in the land registry data whether the parent ever saw a dollar of it or not. Let us be specific about the numbers so that you understand the scale of what is at stake. The capital gains inclusion rate, which was proposed to increase to 2/3 for gains above $250,000 before significant political debate delayed that change, means that even under the existing 50% inclusion rate, a parent who held bare trust on a property in the Greater Toronto Area from 2018 to 2023 could be looking at a taxable gain of $150,000 or more on paper, translating to federal and provincial tax liability in the range of $30,000 to $50,000, depending on their marginal rate and the province in which they file. That is not a penalty for wrongdoing. That is the mathematical execution of a tax position applied to an arrangement that was structured by professionals, documented by lawyers, and treated as standard practice by an entire industry for the better part of a decade. The people sitting across from this nightmare right now are not wealthy investors with accountants and tax lawyers on retainer. They are the anxious boomers who watch their children struggle with affordability, who stepped in with a co-signature and a notarized side agreement, who never thought they were doing anything more complex than helping their family. They are the same people who shared our videos about the inheritance trap in their family WhatsApp groups, who sent the TFSA audit video to their siblings, who lay awake at night running numbers they do not fully understand. The CRA systems do not care about their intentions. The algorithm does not process love. It processes title transfers and date stamps and assessed valuations, and it produces a number. And that number is now arriving in envelopes on kitchen tables across the country. What makes the trap deeper, more unforgiving, and more legally complex than almost anything else we have examined is what happens when the parent tries to simply unwind the arrangement to make it go away. The instinct when a person realizes they are sitting inside a potential tax problem is to act quickly and clean up the structure. Remove the name from title. Transfer legal ownership fully to the child. Get out of the arrangement before the audit arrives. That instinct is not wrong as a general principle, but in the bare trust context, it can accelerate the very taxable event the parent is trying to avoid. The act of unwinding the trust, of removing the name from title, is itself the disposition that the CRA may assess. And moving quickly without proper legal and tax advice does not escape the trap. For many people, it springs it. The professionals who understand this landscape, the tax litigators and estate lawyers who are now fielding calls from panicked parents at a volume they describe as unprecedented, are unanimous on one point. The bare trust situation is not a problem that resolves itself quietly. It is not a situation where waiting and hoping the CRA's attention goes elsewhere is a viable strategy. The data matching is automatic. The systems are running continuously. The question for families inside these arrangements is not whether the CRA can find them. The question is what position they want to be in when the agency does. And now, if you are watching this and you have never been inside a bare trust arrangement, if you are one of the priced out Canadians who watched your neighbors and colleagues and former classmates leverage every financial tool available to them during the boom years, watching amateur investors and weekend landlords accumulate properties while you sat on the sidelines saving carefully and refusing to take on debt you could not genuinely service, there is a moment happening right now that this channel has been documenting since its first video. The mathematical reckoning that was always embedded in the structure of that boom is executing. The arrangements that seemed clever and aggressive and professionally managed are being audited one by one. The phantom gains that sat on paper for years, the appreciation that never translated into real financial security because it was always leveraged against the next purchase. Heritage are now being assessed as income by an agency that has unlimited time, unlimited legal authority, and a data infrastructure that is more comprehensive than most Canadians have ever understood. The family who bought 2 properties, put a parent's name on both titles, and told themselves they were building intergenerational wealth is now receiving the bill for a decade of paper gains. The person who advised them is not receiving that bill. The lender who required the cosigner arrangement is not receiving that bill. The law firm that prepared the bare trust documentation is not receiving that bill. The family is receiving it. And the family, in most cases, does not have $30,000 or $50,000 sitting in a savings account waiting for exactly this moment. There is a specific provision in the Income Tax Act, and it is worth understanding in plain terms. When a bare trust arrangement is identified and assessed, the CRA's power to issue a notice of reassessment extends back in time. If the agency determines that the original acquisition created a taxable position that was never reported, the reassessment can reach back to the original transaction date. The normal 3-year reassessment window that many Canadians believe protects them from old transactions does not apply when the CRA's position is that the arrangement was a trust that required reporting and that reporting did not occur. The extended reassessment period, which can reach 6 years under normal circumstances and has no effective limit when the agency identifies a failure to report a specified foreign property or a trust interest, hence means that families who structured these arrangements in 2017, 2018, and 2019 are not protected by the passage of time. The clock in the CRA's framework did not start running until the arrangement became visible to the system, and it has just become visible. This is not a situation confined to the Greater Toronto Area or Metro Vancouver. It is not a situation that affects only high net worth families or sophisticated investors. The arrangement we are describing was used in Ottawa and Hamilton and Calgary and Edmonton and Halifax by ordinary families who were trying to solve an ordinary problem. The affordability crisis created the conditions for these arrangements to proliferate. The data infrastructure now being deployed by the Canada Revenue Agency will find them wherever they are. The geography does not matter. The income level of the parent does not matter. The sincerity of the original intention does not matter. What matters in the CRA's mathematical and legal framework is whether a taxable event occurred and whether it was reported. If you are inside one of these arrangements right now, the single most important action you can take before the end of this tax year is to obtain a written legal opinion from a tax lawyer, not an accountant, not a financial planner, but a tax lawyer, about the specific exposure created by your specific arrangement. The distinction between a bare trust and other forms of co-ownership matters enormously. The documentation that was prepared at the time of the original transaction matters. The side agreements that may or may not exist matter. These are not questions that can be answered by watching videos or reading general guidance. They require professional analysis of your specific documents. What this channel does is tell you that the threat is real, that the enforcement architecture is operational, and that the families who are going to emerge from this situation with the least damage are the ones who stop treating the CRA's attention as a hypothetical and start treating it as the mathematical certainty it has become. The Canada Revenue Agency did not create the affordability crisis that pushed families into bare trust arrangements. It did not design the mortgage qualification system that made co-signers necessary. It did not write the real estate marketing materials that told a generation of Canadians that property ownership was the only path to financial security. But it is the institution that will execute the financial consequences of those systems. One title, transfer at a time, one reassessment notice at a time, one kitchen table at a time, in envelopes that arrive on Sunday mornings when the coffee is still hot and the day still feels like it belongs to you. That morning is ending for a very large number of Canadian families. The question is whether yours is next. If this investigation has made you realize that you or someone in your family may be sitting inside a bare trust arrangement that has never been professionally reviewed, share this video with them now. The window to act with professional guidance rather than react to a CRA notice is closing faster than most families understand. Subscribe to Canada Property Watch so that when we release our next investigation, you receive it immediately. Because our next video goes inside something that is operating at an even larger scale than the bare trust trap. We have obtained documentation showing how the CRA's net worth audit system, the same methodology used against organized crime and underground cash businesses, is now being applied to ordinary homeowners who paid for renovation work in cash, sold a property privately, or deposited large amounts into accounts without a paper trail that the agency considers satisfactory. The number of Canadians currently under this form of silent pre-audit surveillance is higher than any official statement has acknowledged. The dollar amounts involved in the reassessments that are already being issued will redefine what you thought was possible. That investigation goes live on this channel next. Do not miss it.